Warning, the registered silver stockpile just collapsed. Bank run, 4.2 million Oz depleted. Right now, as you're watching this, vaults in New York are being systematically emptied. Not by investors, not by speculators, but by those who understand what registered truly means. The number that appeared on trading screens this morning is not just a withdrawal. It's a signal that the foundation beneath the entire silver market is cracking. And when registered inventory falls below a certain threshold, something unprecedented happens. Something the financial system has spent decades trying to prevent. The question isn't whether it will happen. The question is, do you understand what happens when the registered stockpile hits zero? Welcome to Silver Radar. If you've been following markets long enough to remember when information wasn't instant, when decisions required careful analysis, not emotional reactions, then you understand the value of what we're about to share. We'd appreciate it if you'd subscribe to this channel, not because we're chasing numbers, but because what's unfolding in the silver market deserves a measured analytical voice. And frankly, we suspect you're someone who still values that approach. Before we begin, drop a comment below and let us know, where in the world are you watching this from? Because what's happening in these vaults, it's not just an American story anymore. Now, let's examine exactly what just collapsed. January 22nd, 2025. A notification pinged across trading desks worldwide. COMEX vault report updated. Most traders glanced, scrolled past, continued their day, but a few stopped. Their screens froze on one number, 4.2 million ounces withdrawn, not moved between categories, not reclassified as eligible, gone, completely depleted from registered inventory. For the average investor watching silver climb toward $99, this seemed irrelevant, just another administrative data point. But for those who understand exchange mechanics, this was a flare in the night sky, a distress signal. Because what most people don't realize is that COMEX operates on a two-tier inventory system, and what just happened affects the tier that actually matters. Let's establish the foundation. COMEX, the New York Commodities Exchange, is where silver futures contracts trade, where price discovery theoretically happens, where billions in paper claims change hands daily. But here's the critical detail most market participants overlook. Silver in COMEX vaults exists in two distinct categories, eligible and registered. These aren't interchangeable terms. They represent fundamentally different types of metal with fundamentally different purposes. Eligible silver meets exchange standards, proper weight, correct purity, stored in approved facilities. But it's not available for immediate delivery against futures contracts. Think of it as silver sitting on the sidelines, watching the game but not playing. Registered silver, however, is the difference between a functional market and a broken one. Registered inventory stands ready for immediate physical delivery. When someone buys a futures contract and demands actual metal, that metal must come from registered stockpiles, not from eligible, not from promises, not from we'll figure it out later, from registered. Right now, as of this morning, total registered silver in COMEX vaults stands at 28 million ounces. The 4.2 million ounce withdrawal represents 15% of that total in a single reporting period. Let's put that in context. Over the past 5 years, normal monthly withdrawals averaged 800,000 ounces. Some months saw 1.2 million. Rarely did it exceed 1.5 million. What just happened was more than 3 times the normal monthly flow compressed into days. This isn't gradual rebalancing. This isn't seasonal adjustment. This is systematic extraction, deliberate, calculated, accelerating. Now here's where the mathematics become dangerous. Current open interest in COMEX silver futures represents over 900 million ounces. That's 900 million ounces of contractual claims, legal obligations to deliver metal, backed by how much registered physical silver? 28 million ounces. Do the division, 32 to 1. For every single ounce of deliverable metal sitting in those vaults, there are 32 paper contracts claiming ownership. Now subtract 4.2 million ounces from that equation. The ratio doesn't just increase, it destabilizes, because the entities withdrawing this metal, they're not confused. They're not making mistakes. They understand something the broader market hasn't internalized yet. In commodity markets, price discovery happens where physical settlement occurs, and physical settlement requires registered inventory. Without adequate registered stockpiles, the exchange faces an impossible choice. Either prices must rise dramatically to attract new metal into registered status, or the integrity of the futures contract itself becomes questionable. History isn't ambiguous about what happens next. March 1980. Silver market chaos. Registered inventories depleted rapidly. Delivery demands exceeded available supply. The exchange didn't let the market clear naturally. They changed the rules mid-game, suspended new long positions, forced liquidation-only trading. The market didn't collapse because silver disappeared. It collapsed because the exchange mechanism broke. But there's a critical difference between 1980 and today. In 1980, the Hunt brothers drove depletion through speculative excess, an attempt to corner the market. Today's depletion has a different engine entirely. Arbitrage, pure economic logic. Silver trades at different prices in different markets, and those price differences create irresistible gravitational pull. The 4.2 million ounce withdrawal isn't isolated. It's part of an accelerating pattern. Last 90 days, registered inventory declined by 11.7 million ounces. That's a 29% reduction in 3 months. Extend this trajectory forward, apply basic mathematics, and the registered stockpile reaches critically low levels in 120 days. Critically low meaning insufficient to cover even modest delivery demands. While traders celebrate $99 silver on their screens, while financial media declares new milestones, while retail investors feel victorious, the physical foundation supporting those prices is being dismantled, ounce by ounce, vault by vault, withdrawal by withdrawal. And whoever is removing this metal, they're not doing it randomly. They're not acting emotionally. They're responding to a simple reality. Somewhere else in the world, that same ounce of silver is worth substantially more, which raises the question that changes everything. Where is this metal going, and why is the price different there? The answer reveals the true nature of what's breaking. While New York sleeps, Shanghai wakes. And when Shanghai wakes, it doesn't see $99 silver. It sees something entirely different. Something that explains why 4.2 million ounces just vanished from American vaults. The Shanghai Futures Exchange opened this morning with silver trading at $130 per ounce. Not $100, not $105, $113. Let that number settle. Because that single number explains everything happening in the registered inventory collapse. The spread is $14. $14 per ounce between what silver costs in New York and what it sells for in Shanghai. In percentage terms, that's a 14% arbitrage opportunity sitting in plain sight. For institutional traders, for banks, for anyone who can access both markets and move physical metal, this isn't a trading opportunity, it's a profit mandate. It's a mathematical certainty begging to be exploited. And exploit it, they are. Here's how the trade works in practice. Purchase silver in New York at $99, secure physical delivery from COMEX registered inventory. Transport the metal to Shanghai, sell at 113, capture $14 profit per ounce. Multiply that by 100,000 ounces, and you've just made $1.4 million on a single shipment. Now scale that to institutional size. Millions of ounces, tens of millions in profit, with virtually zero market risk because both prices are locked in before the metal even moves. This creates what physicists would call a vacuum effect. Western vaults have become the global discount window for silver. Every single ounce sitting in registered inventory is now a target. Not because of speculation, not because of market manipulation, because of pure economic gravity. Capital flows toward profit, and right now, profit flows east. The process is systematic. Traders identify available registered inventory. They take delivery through standard COMEX procedures. The metal is removed from the vault, quality certification verified for international shipping. It's loaded, transported across the Pacific, recertified upon arrival in Shanghai, and delivered into the premium market. But here's the question that should be keeping market analysts awake at night. Why doesn't the New York price simply rise to close this gap? Why doesn't basic supply and demand force COMEX silver to $113, eliminating the arbitrage opportunity? The answer reveals a fundamental flaw in how Western commodity markets function. The COMEX price isn't determined by physical supply and demand. It's determined by futures contracts, by leverage, by paper trading that rarely results in actual delivery. The derivative's tail is wagging the physical dog. On COMEX, participants can control vast quantities of silver with minimal capital through leverage. They can buy and sell contracts representing millions of ounces without ever intending to touch actual metal. This paper market has historically set the global price benchmark. But paper markets have a critical weakness. They only function as long as participants believe physical delivery is possible if demanded. The moment that belief cracks, the moment registered inventory falls too low, the paper price loses its authority. And we're watching that authority erode in real time. Shanghai operates differently. The Shanghai Futures Exchange has tighter delivery requirements, higher margin standards, and a market structure that favors physical settlement. When Chinese buyers purchase silver contracts, they typically intend to take delivery. This creates genuine price discovery based on actual supply and demand for metal, not for contracts. And right now, actual demand for physical silver in Asia far exceeds what Western paper markets are pricing in. The $14 spread isn't a temporary anomaly. It's been widening for weeks. 3 weeks ago, the spread was $8. 2 weeks ago, $11. Last week, $13. Today, $14. The gap isn't closing, it's accelerating. Because every ounce that gets arbitraged out of New York tightens registered inventory further, which increases the stress on the paper market, which prevents the COMEX price from rising naturally, which maintains the arbitrage opportunity, which incentivizes more withdrawals. It's a self-reinforcing cycle. a feedback loop with no natural break. And the entities executing this trade aren't retail investors or small speculators. They're institutions with the capital, logistics, and market access to move metal at scale. Banks, trading houses, sovereign wealth funds. They're not gambling, they're harvesting. They're extracting value from a structural market inefficiency that Western exchanges either cannot or will not correct. Every vault report that shows declining registered inventory is confirmation that this extraction continues unabated. Consider the implications. If you're a corporate treasurer managing silver exposure, you're watching this arbitrage and asking what it means for your hedging strategy. If you're a manufacturer who needs physical silver for production, you're wondering if New York prices will remain reliable. If you're an investor holding paper silver certificates or ETFs, you're questioning whether those instruments are actually backed by accessible metal. Because the arbitrage isn't just moving silver, it's exposing the gap between paper claims and physical reality. And that gap is widening with every shipment that leaves American shores. There's a moment in every financial crisis when the numbers stop being abstract and become visceral, when spreadsheets transform into real consequences, when theoretical risk becomes actual loss. We're approaching that moment in the silver market, and most participants don't even know they're standing at the edge. The depletion isn't slowing, it's accelerating. And the mathematics of what happens next aren't theoretical anymore. They're inevitable. At current withdrawal rates, registered COMEX silver inventory will fall below 20 million ounces within 87 days, below 15 million ounces within 134 days, below 10 million ounces before summer arrives. Now, 10 million ounces might sound substantial until you realize what it means in context. The average daily trading volume in silver futures represents over 150 million ounces. On a busy day, 200 million. The entire registered inventory could be claimed by a single day's worth of contracts deciding to stand for delivery instead of rolling forward or cash settling. But it gets worse. The distribution of that remaining inventory isn't evenly spread across multiple vaults and multiple custodians. It's concentrated. 3 major banks control over 60% of registered silver storage. If any one of those institutions faces a liquidity issue, a strategic repositioning, or simply decides the liability of holding delivery-grade metal isn't worth the operational headache, they can reclassify that silver from registered to eligible with a single administrative action. Legal, permitted under exchange rules, and devastating to anyone holding contracts expecting physical delivery. This concentration risk isn't hypothetical. We've seen it materialize in other commodity markets. March 2022, the London Metal Exchange. Nickel trading. A single Chinese company, Tsingshan Holdings, held massive short positions. Nickel prices spiked, margin calls mounted. The position became unwindable. And what did the LME do? They didn't let the market clear. They suspended trading. They canceled trades that had already executed. They retroactively changed the rules because allowing the short squeeze to play out would have bankrupted exchange members and clearinghouses. The message was clear. When systemic stability conflicts with contract integrity, stability wins. Always. The silver market is now exhibiting similar structural vulnerabilities. Major dealers who facilitate COMEX trading hold net short positions measured in hundreds of millions of ounces. Their business model depends on most contracts never demanding physical delivery. They profit from the spread between paper trading and actual metal movement. But as registered inventory depletes, the probability of delivery demand exceeding available supply increases exponentially. These dealers face a risk they cannot hedge, the risk that the market structure itself breaks. Current margin requirements don't account for this inventory depletion. Position limits remain unchanged despite the shifting ratio between paper claims and physical metal. Regulatory oversight treats this as normal market activity because, technically, nothing illegal is occurring. Metal is being withdrawn through proper channels. Arbitrage is a legitimate trading strategy. The rules aren't being broken. The system is simply revealing that its rules were designed for a different reality, a reality where registered inventory remained stable, where arbitrage spreads stayed narrow, where delivery demands remained predictable. That reality no longer exists. And certain sectors of the economy are about to discover this the hard way. Industrial silver demand isn't discretionary. Solar panel manufacturers can't simply stop production because silver becomes difficult to source. Each gigawatt of solar capacity requires roughly 130,000 ounces of silver. Global solar installations are projected to exceed 450 gigawatts this year. That's 58.5 million ounces of non-negotiable industrial demand. Electronics manufacturing, medical devices, water purification systems, these aren't industries that can substitute away from silver easily or quickly. They need physical metal delivered on schedule at predictable prices. But predictable pricing requires predictable supply, and supply predictability requires adequate inventory buffers. Registered COMEX inventory used to function as that buffer, a shock absorber for temporary supply disruptions, a visible signal to the market that physical metal was available if needed. That buffer is evaporating. And without it, industrial users will face something they haven't experienced in decades: genuine physical shortages at any price. Not higher prices that ration demand, actual inability to secure metal regardless of willingness to pay. Meanwhile, investment demand is accelerating precisely because awareness of these shortages is spreading. Sophisticated investors, the ones who read vault reports and track delivery data, are moving from paper silver exposure to physical holdings. They're requesting delivery on contracts. They're purchasing coins and bars. They're storing metal in private vaults outside the exchange system. This shift from paper to physical adds another layer of pressure on already strained registered inventory. It's not just arbitrage draining the vaults anymore. It's a broader recognition that physical silver and paper silver may not be equivalent assets much longer. Central bank policies compound the pressure. When monetary authorities expand balance sheets, when government debt levels rise, when currency debasement becomes policy rather than accident, hard assets become strategic holdings. We are seeing this play out in gold markets where central banks have been net buyers for 14 consecutive years. Silver hasn't experienced the same institutional accumulation yet, but the setup is identical: limited physical supply, expanding monetary base, growing awareness of exchange system vulnerabilities. The question isn't whether capital will flow into physical silver. The question is what happens when it does and discovers there isn't enough registered inventory to satisfy demand. The warning indicators are already flashing. Futures curves have moved into backwardation, meaning spot prices exceed futures prices. This is the market, his way of saying physical metal today is worth more than a promise of metal tomorrow. Silver lease rates, the cost of borrowing physical metal for short-term needs, have spiked to levels not seen since 2020. Dealers are quoting wider bid-ask spreads. Delivery timeframes are extending. These aren't subtle signals, these are klaxons. But markets can ignore klaxons for surprisingly long periods, right up until the moment they can't. And that moment is approaching faster than most participants realize. Let's synthesize what we know. 2 markets, 2 prices, 1 metal. New York says $99. Shanghai says $113. Western exchanges operate on paper leverage and fractional physical backing. Eastern exchanges demand physical settlement and genuine delivery. This divergence cannot persist indefinitely. Something must give. The only question is what breaks first, and who gets caught on the wrong side when it does. There are 3 possible resolution scenarios, and none of them are comfortable. Scenario 1, prices adjust violently upward. The COMEX price gaps up to match or exceed Shanghai pricing. The $14 spread closes not through Shanghai falling, but through New York catching up. This would validate physical holders, devastate paper shorts, and likely trigger exchange interventions to prevent systemic member defaults. Scenario 2, exchange rules change mid-crisis. Position limits get imposed retroactively. Cash settlement becomes mandatory. Delivery demands get suspended or delayed. Contracts get rewritten. This protects the institutional structure, but destroys confidence in futures markets as genuine price discovery mechanisms. Scenario 3, outright delivery defaults occur. Major dealers cannot source metal to satisfy legitimate delivery demands. Contracts go unfulfilled. Legal battles ensue. The exchange mechanism fractures. This is the nuclear option. The outcome everyone claims is impossible right up until it happens. Probability assessment? All 3 scenarios have precedent in commodity market history. Nickel in 2022 gave us Scenario 2. Palladium in 2000 gave us elements of Scenario 1. Tin in 1985 gave us Scenario 3. The market survived each crisis, but participants who assumed the system would function normally did not. Some lost fortunes. Some lost businesses. Some lost careers. The lesson isn't that commodity markets are inherently unstable. The lesson is that when physical inventory depletes while paper claims multiply, resolution comes suddenly and without mercy. For corporate treasury managers, the implications are immediate. If your company holds silver exposure through futures contracts, ETFs, or allocated accounts within the exchange system, you need to verify the actual deliverability of that metal, not the contractual promise of delivery, the physical ability to take possession if required. This means understanding custodian arrangements, vault locations, and the legal hierarchy of claims if inventory becomes contested. It means stress testing your hedging strategies against scenarios where counterparties cannot perform. It means recognizing that price volatility is the least of your concerns if the metal you're counting on doesn't actually exist in accessible form. For manufacturers dependent on silver inputs, supply chain resilience now demands physical inventory buffers. Just-in-time delivery models assumed reliable spot market access at predictable prices. That assumption is breaking. Forward purchase agreements need to specify physical delivery, not cash equivalent settlement. Supplier relationships need verification of actual metal sourcing, not futures market hedging. Production planning needs to account for potential allocation systems or rationing if physical shortages materialize. These aren't doomsday preparations. These are basic risk management responses to observable market stress. For investors, the distinction between paper silver and physical silver is no longer academic. Silver ETFs, mining stocks, futures contracts, and certificates all provide exposure to silver price movements, but they do not all provide exposure to physical metal. In a scenario where the paper market and physical market decouple further, these instruments will perform very differently. Physical holders may see dramatic appreciation. Paper holders may see contractual rewriting, forced cash settlements, or frozen redemptions. The appropriate allocation depends on your assessment of which scenario is more likely and your tolerance for counterparty risk. The metrics to monitor are straightforward. Registered COMEX inventory, reported weekly. When it falls below 20 million ounces, the system enters critical stress. Below 15 million, crisis becomes probable. Below 10 million, intervention becomes certain. The COMEX Shanghai spread, tracked daily. If it widens beyond $15, the arbitrage acceleration intensifies. If it narrows to below $5, system pressure is easing. Delivery notice trends, published monthly. If the percentage of contracts standing for delivery rises above historical norms, it signals declining confidence in paper settlement. If major commercial hedgers begin requesting delivery rather than rolling positions, it confirms institutional awareness of inventory risk. There are early warning thresholds that should trigger strategic adjustments. If registered inventory declines 20% in any single month, physical allocation should be secured immediately. If 3 consecutive months show net withdrawals exceeding 3 million ounces, supply disruption becomes baseline assumption. If any major dealer announces inability to source metal for delivery, exit all paper positions becomes the only rational response. These aren't hair-trigger panic signals. These are informed decision points based on observable data. The bank run metaphor is precise. In fractional reserve banking, institutions hold claims far exceeding actual deposits. The system functions as long as depositors don't all demand withdrawal simultaneously. But when confidence cracks, when enough participants request their money at once, the mathematical reality becomes undeniable. There isn't enough. The first to withdraw succeed, the last in line get nothing or get restructured claims. Silver markets now operate on similar mechanics. Registered inventory is the deposit base. Paper contracts are the claims, and the claims vastly exceed the deposits. First mover advantage matters in this environment. The entities withdrawing 4.2 million ounces weren't panicking. They were positioning. They understood before the broader market that registered inventory depletion creates asymmetric opportunity. Get physical metal now while it's available at paper prices. Because once the system recognizes the shortage, prices won't adjust gradually. They'll gap. And gaps don't offer entry points. They offer regret. This is not temporary volatility. This is not a trading opportunity that will cycle back. This is structural market failure in the early stages of manifestation. The commodity exchange system was built on assumptions that physical delivery would remain the exception, not the norm. That registered inventory would stay adequate because most participants preferred cash settlement. That arbitrage opportunities would self-correct through natural price adjustments. Every one of those assumptions is proving false simultaneously, and when foundational assumptions break, the structures built on them don't bend, they fracture. The professional imperative for anyone managing capital, overseeing supply chains, or advising clients is clear. Understand that silver pricing is undergoing regime change. The paper market that dominated for decades is losing authority. The physical market that was ignored as inefficient is becoming the true price discovery mechanism. Position accordingly. Verify actual metal access. Stress test counterparty dependencies. And recognize that what's happening in silver vaults right now isn't a data point, it's a signal. The question is whether you're positioned to benefit from understanding it early or positioned to learn about it expensively later.